It's interesting here that all these new smart beta ETFs keep being introduced, even though there's more demand for other kinds of ETFs, at least for now. I guess hope springs eternal. One of the new ETFs you're looking at is a low volatility ETF. I mean, there are already a lot of low vol products out there. What makes this one different?
Right. This is the PowerShares minimum variance S&P 500 ETF. Couple reasons this sticks out. First of all, low volatility is now big business. Even though it's not that respected as a factor within the academic community, I'd call it like a JV factor. Investors love it. They love getting the market with a little less edge. So this one is essentially like SPLV, which is their low volatility portfolio, which just gives you the 100 least volatile stocks in the S&P 500. This one basically goes and gives you a low vol portfolio of the S&P 500, but with sector weightings that are similar to the S&P. That's one of the wraps on SPLV, is that it's got overweight certain sectors like utilities and staples. This is very similar, and it's a competing product to USMV, which is iShares minimum volatility portfolio. So, you know, you have this increasing competition in the ETF space. So basically, PowerShares came out first. iShares answered with a unique product. Now PowerShares is answering back to the iShares product. But all in all, you know, there's a $40 billion market in low vol ETFs, and so there's probably going to be some market for this new product.
Right, that would explain that introduction. What about this new pro sports ETF that launches today? I mean, on the face of it, doesn't sound smart beta, right? Sounds pretty straightforward, but you say it actually is a factor-based ETF in disguise.
Yeah, I do. You know, first of all, theme ETFs I tend to put into the smart beta category, but this one definitely is because it equal weights. So before you even talk about the fundamental story, pro sports, the revenues are up, I get it. You're going to equal weight basically a basket of stocks. Now, when you equal weight stocks, you essentially are giving smaller cap stocks a louder voice, right? That introduces you to the size factor. So essentially, this ETF will probably outperform in bull markets and maybe underperform in bear markets because you got a little extra volatility. You also want to look at overlap when you look at these thematic ETFs. And if you look at this ETF versus, say, the S&P 500, there's about a 50% overlap. To me, that's a bit on the high side. You know, you look at something like the video game ETF, which sounds equally as themey, but that one only has a 5% overlap with the S&P 500. So when you look at theme ETFs, you got to look, how is it weighted, what's the volatility, and how much overlap does it have to something I probably already own.
And of course, these are just a couple of examples of all of these new smart beta ETFs that are coming out. And not only are there new issues, there are new issuers, at least new to this particular universe. So we've got some big asset managers that are coming out with new smart beta ETFs. What are some of them, and what's sort of driving it?
Yeah, look. Basically, what you have is a massive repackaging of active mutual funds into smart beta ETFs. So a lot of the big managers that you love and know who haven't really done anything in ETFs, that's what they're doing. USAA just filed for value momentum ETFs. Transamerica is going to have risk-weighted smart beta ETFs. Oppenheimer is going to factor weight. American Century is getting into the game. And then Fidelity is also launching a line of smart beta ETFs.